The challenge for investors today isn't deciding whether artificial intelligence will change the economy. That's already happening. The real question is, how do we maintain a balanced portfolio while markets climb to new all-time highs? With tech stocks soaring, it's tempting to double down on what's been working. But successful long-term investing means balancing growth opportunities with smart risk-reward management. Much of the recent market growth has come from a small group of mega-cap tech companies, often called the Magnificent Seven. These include Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. Together, they now make up about 35% of the S&P 500 and dominate market headlines. Many are hyperscalers, tech giants that are investing heavily in AI infrastructure to meet the explosive demand. But when just a few companies drive most of the market, it's critical to zoom out and look at valuations, history, and diversification. Innovation has always driven markets. Think of railroads in the 1800s or the internet boom in the 1990s. Back then, companies like Pennsylvania Railroad were as dominant as today's tech giants. Each wave of transformation followed a similar pattern: early skepticism, rapid adoption, investor excitement, and then a return to economic fundamentals. Some companies failed, while others became household names. The key lesson: innovation transforms industries, but markets don't always price that transformation correctly in the short term. Artificial intelligence is attracting massive investment. Over $100 billion in private funding in the US alone last year. Microsoft and Nvidia, for example, are seen as building the infrastructure for the AI economy, just like railroads supported commerce in the 19th century. But here's something you must consider. The S&P 500's price-to-earnings ratio is now at about 22.5, close to historic highs. Investors are paying a premium based upon expectations that may not play out as quickly as hoped. We've seen this before. In the dot-com bubble, excitement outpaced earnings, and when expectations didn't match the reality, the NASDAQ dropped nearly 80%. So what does this mean for your portfolio? If you're investing in a broad index fund, it's likely you already have exposure to the Magnificent Seven. If you've added extra weight to tech, you might have more risk than you realize. It's what we call concentration risk, when too much of your portfolio is tied up in just a few companies, because even great companies can stumble. For comparison, equal weighted indices, which treat each stock the same regardless of size, have often outperformed during periods when mega-cap stocks underperform. The bottom line: AI is real and the opportunities are big. But smart investing isn't about chasing hype, it's about balance. History tells us that innovation does lead to long-term growth, but markets are forward-looking and often overshoot. So rather than trying to pick the next big winner, focus on building a diversified portfolio that aligns with your long-term financial goals. That's how you stay grounded, no matter how high the market climbs.